Did the AI bubble just pop? Or did Wall Street just hand you the best dip buying opportunity of the year? Take a look at the board today. After a brutal sell-off over the past week, semiconductors are fighting back, with the semiconductor ETF ripping over 5% higher. Meanwhile, the Nasdaq is surging and Bitcoin is quietly catching a massive institutional bid. But before we blindly buy this bounce, we have to look at the math and the charts, because a relief rally is not the same as a confirmed trend. Today, I'm going to share the institutional report showing why big banks call this a positioning flush, walk you through a quick masterclass on the earnings maths so you can see why these stocks are suddenly cheap, and then dive into my charts to pinpoint the exact levels needed to confirm a real turnaround. So after the carnage last week, a 5% day feels good, but we have to be reminded that the price is still in the cloud, and as a technical trader, it does not confirm the trend just yet, as we still have a bearish cloud and price is still below the 10 and lagging span is below price. But to really understand whether this is the start of a new trend, we must look at why the stocks dropped in the first place. And looking at this article here, Wall Street strategists are framing the recent pullback as technical, not fundamental. UBS described the move as a positioning unwind following a 90% year-to-date rally, suggesting that the damage reflected forced selling and profit taking rather than a change in the underlying setup. So what they were saying is that effectively there is too much greed in the market, resulting in a crowded trade and effectively some liquidated selling, and it wasn't a fundamental issue, with reports suggesting AI sell-off was maturing and earnings will provide a floor, and the unwind in artificial intelligence and momentum stocks is entering its maturing stage and should not trigger prolonged market weakness, according to JP Morgan, despite drawdowns of over 20% among many heavyweights, and that semiconductors in particular should soon find a bid, as the bank argued AI groups should not keep falling in absolute terms for long, given a likely continued strong earnings uplift and growing valuation support. And now that the leverage is cleared, the banks seem to be calling this sector oversold, despite geopolitical events in the Middle East. And I wouldn't say oil has stabilized, but it certainly didn't manage to confirm a trend, as price is still below the cloud. And the VIX is still below 20, and when it is, I still take my full position sizing. And with Micron being a crowd favorite, I want to take a minute to show you how institutional desks determine whether a sector is actually cheap or expensive. And because a stock dropping 15% doesn't automatically make it a bargain, it could just be going from extremely overpriced to slightly less overpriced. And to value a sector, you look at its forward PE ratio, the current stock price divided by its estimated future earnings per share. The rally paradox that catches most retail traders off guard is that a stock can double in price but actually get cheaper. If a stock's price goes up 100% but its future earnings estimates get revised up by 400% due to massive demand, the forward PE ratio collapses. The price went up, but you're paying less per dollar of future profit. And if you look at this FactSet graph, published on July 17th, we can see the forward PE ratio for each sector, with the dark blue marking the current, the light blue marking the 5-year average, and the green denoting the 10-year average. And if you look at tech, we can see it's currently got a forward PE ratio of 22.3, which is below the 5-year average of 25.8. And this proves that even after the massive rally we've experienced earlier this year, the tech sector is currently trading at a discount to its 5-year historical baseline. By comparison, the S&P 500 is trading at 20.3, right near its historical average. And if we look at Micron, for example, the current forward PE is 5.58, with an average over this period being around 13. And the current forward PE of 5.58 is significantly lower than the forward PE of the information technology sector, suggesting that Micron is a cheap stock. However, it is not trending bullish. To confirm its bullish trend, I would like to wait for new all-time highs, or alternatively, a close above the Kijun here, with an entry for my trading conditions being valid right around here. And FactSet also reports that 87% of early S&P reporters have cleared profit expectations. If a company's future earnings estimates are revised up before selling knocks its price down, the forward PE multiple compresses violently into deep value territory, and because we saw the forward PE drop for a bunch of stocks, it was a point for institutions to start accumulating, but it remains to be seen if this is the start of a full trend. FinViz pretty much confirms tech had a great day, and we've almost had a positive day right across the board, and this is confirmed by the equal weighted Russell closing positive, but we are still below the Tenkan line and lagging span is close to touching price. The Nasdaq also closed a positive at almost plus 2%. However, we've still got a bearish cloud and price is still in the cloud, and lagging span is below price, which explains to me some of the results I've been seeing on my screen now. XLF is flagged up on technicals, as you can see is building a base here, and entries above this neckline here would be valid. XLV, which is the healthcare ETF, attempted a breakout right around here, but failed to sustain the highs, and it looks like we are confirming the Kijun here as support. Lagging span is above price, and the cloud is bullish, and I'd be waiting for new highs before I start to look in the healthcare sector. DRAM closed up at over 10%, but my volume screener is telling me that the institutions are utilizing a barbell strategy, so clearly there is an appetite here for some risk on, but HDV having significant volume is indicating that there is some risk off as well this week. However, I note the large volume candle here, and it could be producing erroneous results. However, BCI seems to also be catching a bid, which is a commodity ETF, and it looks like we're getting close to a cloud breakout. HGER is also seeing some follow through, increasing the validity of the barbell strategy thesis. BitO, which is the Bitcoin ETF, received another bid today. If you look at the weekly, everything is bearish. We've got price still below the Tenkan, and price below the baseline. Price is also below the cloud, and the cloud is bearish. However, the lagging span is now close to price, indicating that we are moving from a bearish market to a ranging market on the weekly. The daily tells a slightly different story, as the lagging span is above price, and price is above the baseline and the conversion line, but we're still below the cloud and the cloud is still bearish. But if you look at the Bitcoin dollar index, we're effectively in the cloud. And the cloud represents a vacuum, indicating that we can anticipate price to come up above the cloud at some point. So we could say Bitcoin has found a short-term bottom and could potentially decouple from the Nasdaq as discussed in my previous video. And eBay also had some significant volumes as well, which tells us that people might be moving over to the crypto markets, with the Ethereum index teasing bullishness. As we have a bullish cloud, the price is above the cloud, lagging span is above price, the price is almost above the cloud, with a 1-to-1 move being about 20% from the neckline. And if you believe in chart symmetry, this could happen very soon. My individual stock screener also flagged up a few stocks, which I'll share with you now. Bull, which aligns with the crypto theory, and fundamentally might see a bid if Bitcoin gets more and more attention. We've had a neckline breakout here. I appreciate the weekly candle hasn't closed, but we're still bearish on the weekly, as it is a huge IPO dump. On the daily, however, we've got lagging span above price, we've got price above the cloud and the neckline, and the conversion line and the baseline are pointing up, indicating a strong trend, as well as the cloud, and has a decent way to go until we get to the target. There's also HOG, which has just had a bullish twist on the weekly, and the target is about 20% away from the neckline. However, we might see that very soon. We've had a neckline break, lagging span is above price, and similarly to Bull, the conversion line and the baseline are both pointing up, indicating strong momentum, as well as the cloud. We've got Forward Air Corporation, which just broke above the neckline, and the cloud on the same day. The cloud was just twisted bullish, the lagging span is above price, but still under the cloud, and it's got a significant 1-to-1 move ahead. However, we've got overhead resistance here at the baseline on the weekly, and we have the cloud as well. If you found any value in my video, please like, comment, share, and subscribe.